board. All right, can you all see it?
No.
No.
I
I
got
mean, you're recording, yes, but not the screen.
There you go. Now you
Right
can
there.
see it. Okay, so this is case 10, group 7. So question 1 asks, what are the advantages and disadvantages of going public? Do you agree with Billy's concerns, or do you concur with the other members of the Goodman family regarding the insurance of the IPO? Explain why. So initial public offering is company's initial selling of a stock. IPOs are typically launched by small businesses seeking to raise cash to expand their operations. The corporate value model is $20 in comparison to 40 plus. When taken into account the competitors, it makes sense to go public. So advantages is of going public is capital obtained through an IPO can be used to pay down debt, support growth ambitions, fund R&D and other expenditures. And another advantage is that once it goes public, awareness will be increased, resulting in an increase of market share. So more people will know about your company once you go public, and it's easier to gain access to capital than other than just banks and financial institutions. You could gain capital through stockholders. So disadvantages of going to IPO is even with the benefits of IPO, companies frequently encounter several obstacles. The businesses must follow the Securities and Exchange Commission's, the SEC's laws and regulations, which may be quite stringent for tiny startups. Firm lose control when the public buys IPOs, resulting in continuous examination of the firm and management choices. So once you go public, you don't have all the say in the company. You have a board of directors you got to go to. You have stockholders that you got to think about. You don't have full control of the company once you go public. So those are the disadvantages.
All right, question 2. Comment on Callie's preference of the corporate value model. Based on her approach, what would Orange Bright's selling price per share be if they were to issue 30 million shares? Okay, so Kelly prefers the corporate value model because it represents valuation that is directly tied to expected cash flows rather than market conditions. So calculating the firm's value and subtracting debt in our problem, the share value of the discontinued future cash flows is 20 per share.
You could see how we calculated this through our Excel sheet.
Okay, so question 3 asked, how does Kelly's price estimate compare with Billy's price estimate based on the price ratio models, and what are the pros and cons of Billy's preferred approach? So based on the price ratio models, Kelly's price was adjusted to $20 per share, while Billy's price was $46.92. The $26.92 gap between the two approaches is considerable. This makes us believe that Kelly's method is untrustworthy, as it is the only price estimate that is significantly incorrect. The approach used by Billy provides valuation ratios from all competitors. And as you can see, the chart on the top, it explains a little bit better by putting in all the values.
Yeah, those formulas are in our Excel sheet as well once you click it.
Correct.
Question 4 asks, how far off would Joey's price estimate be if he were to use a 3-stage approach with growth assumptions of 30% for the first 3 years, followed by 20% for the next 2 years, and a long-term growth assumption of 6% thereafter? Assume that the firm pays a dividends of $1.50 per share at the end of the first year. So according to our results, the price at the end of the non-constant growth phase is $65.05. The intrinsic value would be $44.95, which is fairly close to Billy's initial 46 with 92, but far from Kelly's price of $20. And here we have the chart showing that our calculation.
Yeah, all those formulas are also on Excel sheet. You can see how we calculated it. Okay, so question 5, based on all 3 estimates and the valuation figures for the 3 competitors, how much per share do you think that the Orange Bright is worth? Explain your rationale. So based on the 3 estimates, our results state that the average is $37.29. We think Orange Bright is worth $48 to $50 because these prices are relatively close to the average most competitors' prices. So what we did to find the price that we think that they should issue per share is just average all of the estimates of Kelly, Billy, and Joey's, what they got, and we just averaged it to find a median price So that's what we did, and according to the competitors, they're anywhere from $48 to $50. So we think $37.29 will be a very good price to issue when releasing the IPO. That's it. Stop share.